You're in the elephant bar. It's starting to slip. It's not going right away. It's slipped from the top third into the second third. It's still okay. Now it's slipped into the bottom third. Now it's not okay. Next move up, out, regroup. If you can just apply this third concept to your elephant bars, your game is going to be elevated beyond what you can truly grasp right now. And like all concepts, guys, this is something that rewards forever for life. Remember, it works, even though I've taught it from the bull side, it works from the bear side as well. Strong red, green stays in the bottom third. Boom, continue red 80% of the time. Remember your stats, remember your statistics. Make this yours. It's still mine. You understand it intellectually, but it has to become experiential knowledge to become yours. Now use it, grapple with it. That is your week's assignment. Of all of your trading events are going to come from elephant bars. This is something you need to write down, guys. 65% of all of your trades, all of your opportunities, everything out of everything you're going to do, 65% of it's going to be based on some variation of an elephant bar. All right. What you're looking at on this chart, all right, is the opening elephant bar for Apple. All right, guys, you know what an elephant bar is. It's not a normal bar. It's a little longer than average. It's more solid, more full. All right, the wicks on either side, if there are wicks, are relatively small in nature, but there's a lot of green or a lot of color in the bar. That's an elephant bar. They're significant because you and I can't create an elephant bar in Apple. If we put all of our money together, we would still not be able to create an elephant bar in Apple. Why? Because it takes billions of dollars to do so. Why do I call them elephant bars? Because they're the footprints of institutions. What are institutions? They're the big elephants and the big whales that move life in the market, okay? So elephants represent 65% of all of your activities. Now, there's another statistic I want you to know about elephant bars. Not only do they represent 65% of all of your activity, they have about a 70% follow-through rate, which means, let me draw this. So elephant bars will tend to produce additional green. That's additional green 70% of the time. So there's a 70% follow-through rate, meaning more green to come on a green elephant bar 70% of the time. You know what that means? That means 7 times out of every 10 you're going to at least temporarily at least have money. If you buy the elephant bar 70% of the time, you're going to have money at some point after that elephant bar, 7 times out of every 10. If you do elephant bars 10 times in a row, 7 times on average, which means that sometimes it's 6, sometimes it's 9. The average is a 70% follow-through rate. That's huge. That is a high enough rate to get fabulously wealthy at this game just playing elephant bars. Very important to understand. Now, that's a 70% follow-through rate on elephant bars, and elephant bars happen 65% of the time, which means that out of all that we do, 65% of our trades are going to be elephants, and those elephants have a 70% follow-through rate. Now, let's continue this. The elephant bars that there is a possibility for that average to be upped. And so we can get this to 80% follow-through rate with one simple thing. Okay? 80% follow-through rate on elephants that subsequently stay in the top third of their elephantness. All right? For lack of a better word. All right? So let me draw this. Here's an elephant bar's range, right? And if I were to cut this elephant bar into thirds, I want all subsequent activity to stay in that top third. So if it doesn't go right away, because sometimes the elephant goes right away, right? But if it doesn't go right away and the philandering around stays, doesn't penetrate the top third, now it's 80% follow through. 80% follow through. So without this top third, there's 70%, believe it or not, the top third rattling around and then goes, makes this 80% follow through rate. So it's almost like the stock rallies, gets a chance to pause a little bit, and that brief pause right there, that brief step back allows it to leap more aggressively and more assuredly. More assuredly. So think about that. Think about how you come up to a water puddle, boom, step back, and then leap over that water puddle. All right? And so if you look at Apple today, look at how it drops. Look at how it drops. And then goes. Tell me you see this. Tell me you see what I'm pointing out. Let me know. Do you see it? You see how it dips, comes back, dips, comes back, and boom. Do you see the two dips there? Do you see it stay relatively in the, those dips stay relatively in the top portion? Whoa. You see it? All right. Boom. Now, look at this. Take this elephant bar. Okay? You see what I'm saying? Boom. I want you monitoring that top third all the time, every time there's an elephant bar, because the very best ones, if they don't go right away, you've got to be able to judge, well, is this still good? Yes, it's still great if it's staying in the top third. In fact, it's getting better if it's staying in the top third. Do you understand? Your elephant bar is improving if it's staying in the top third. It's garnering up more and more strength. And it's moving from the 70% version to the 80% version. Wow. Can I get a wow? Oliver just taught us how to filter out the 80%ers. Wow. Can I get one of those, please? Pretty please? Okay. All right. Sometimes I like the little pats on the back. You know how it goes. All right. So let's see if I can think of anything that was another third today. What was another third today? Can anybody find anything for me? Elephant bar, rattle around in the top third, and boom. What else was there? I don't know. Let's see if we can find something here. No. Well, I like the Amazon. Amazon is just a pure elephant bar surge off the 200. That's beautiful. and it's clearing to boot too. So that's a very, very beautiful play here this morning. Power surge elephant bar off the 200, guys. Those of you who've been with me for a while, you know how powerful that is. All right, but I don't see where you see the third aspect that we're talking about today. All right. Yeah, I like this. Microsoft. All right. So here's your elephant bar, and it kind of meanders around here, but it's staying, it's not dipping down here. You understand? So it's staying relatively close to the top third, and boom, it follows through. Notice how this elephant bar did not stay in the top third. All right. That's the top third. It broke not only into the second third, but it broke all the way into the bottom third, then came back. You have to sell this. This is called a damage control play. So if you've got the elephant bar, that's the reason for your trade. Here's top third, here's bottom third. Coming into the second third, staying in the top third is the best. Coming into that second third is okay, but when you get into that bottom third, something's wrong. Do you understand? And so sell out on the next move up, because your whole elephant has been robbed from you. They took your elephant away. You didn't have it on a leash. I don't know what happened. They just took it away. Your elephant's gone. So get the heck out of Dodge on the next bounce. Why are you hanging around? So a trader of mine was in this elephant bar. The red took his elephant bar away. They stole it, and he didn't exit on this bounce. He sat there thinking like, okay, everything is still fine. I'm going to get my nice play to the upside. Your elephant's gone. Get the heck out of Dodge and let this thing drop, or maybe even reverse once you get the clearing, because here's that clearing. Boom. And so this 1/3 concept, guys, if you focus a week on this 1/3 concept, wow. Do you understand how far you're going to go in terms of deepening your filtering process, deepening what you see as greater opportunity versus lesser opportunity? What you see as, wow, this is about to go, because it's staying in that third, that sweet spot, which is the top third, or in a bear, the bottom third. Guys, when you look at this fat red bar here, you see that? See that fat red bar? Look at where the green stayed, in the bottom third. That's why you got continuation. That green didn't break into the top third. It stayed within the bottom third. It's very powerful. All right? So it works the same way. You're not supposed to be searching for anything. They're supposed to be choosing you. Your trades are supposed to be choosing you. You're not supposed to be searching. If you're searching, you're still in novice land. And I thought you're supposed to have left novice land when you came to me. No searching, waiting. You should have 6 to 8 stocks, every single open, that are choosing you or wanting to be chosen. It's my turn. It's my turn. PayPal, it's my turn. I'm gapping and showing you red. Can you play me? I'm surging off the 200. Can you play me? You understand? Like, which they're vying for your attention. You're not searching for them. They're searching for their opportunity with you. If you're doing this right, if you're doing this correctly, you are not searching. You're just waiting for the best one to say, ooh, ooh, Oh, it's my turn. It's my turn. They had chances before. It's my turn. And that's what a master does. On the floor of the New York Stock Exchange, you've seen this in movies, guys, if you haven't seen it, and if you haven't done the tour and seen it in real life. There are pits where a specialist for each stock has its own pit. So IBM has one specialist in a pit, a round pit, and other traders crowd around that pit. You'll have another pit for something like McDonald's, and another pit for Home Depot, and another pit for Walmart, all right? Anyway, this one specialist is waiting for the crowd to come to him. Sometimes the Walmart specialist doesn't have a crowd, and the crowd is at McDonald's, or the crowd is at IBM. And then sometimes there's no crowd at IBM, but there's a crowd at Walmart. So the specialist, when the specialist for Walmart, all right, in his pit, doesn't have many traders around his pit, because the action seems to be in IBM today. The specialist doesn't leave his pit and say, hey, what's going on over here? Why is my pit so empty? The specialist doesn't do that. The specialist sits and waits in his pit and says, you know what? It'll be my turn. It's always my turn, and eventually they'll come back to this pit, you know. And so this is how I want you doing. You're sitting in a pit. You've got 10 things surrounding you, or 6 things, or 8 things surrounding you, and they're vying for the specialist, your attention. And you're going to choose, okay, you, because you are the strongest bar this open off of a flat 200. You're the one I choose. Now, that's not searching. So the reason why I'm talking to you this way is because of a question. I just want to make sure this question is not coming from the view that you should be searching. Oliver, how did you choose PayPal? I like the wording. How did I choose PayPal? Not how did I find PayPal? So I like the how did you choose it versus how did you find it. I'm not searching for anything. It's coming to me. And that little subtle difference is all it takes to separate you from the masses, is that you're not a searcher, you're a chooser.